Hello world, welcome to Farm the Market. On the Stock Trading Journal series, I share with you some of my trades. I will not explain a given strategy in depth or claim that I have the quote-unquote unique epic strategy that beats the market every time. I just hope it's a good exercise for me where I get to analyze some of my trades deeply by explaining them to you, rather than just logging numbers and notes in my blotter. After all, you know what they say. If you want to understand something well, try to explain it simply. And hopefully for you, by looking step by step at examples of real trades, you might find interesting some of the techniques or adjustments I use on my trades, and this might help you in your journey to develop your own trading skills. This time we will look into Las Vegas Sands. Let's get started. After a drop of almost 50% during 2021, LVS seemed to be trying to form a base around the mid-30s price during the September-October period. Volume was declining in general, and after the earnings report, the stock didn't move much in price or volume compared to the most recent spike. With all that in mind, it looked to me like it was forming a nice contracting pattern. Of course, as with any chart analysis, it's subjective, but it seemed to me there was enough there to expect the pattern to continue to develop. So I decided to set up an options strategy looking to benefit if that actually happened. On November 12, 2021, I decided to buy a call spread from 40 to 45, and to fund that purchase, I sold a naked put at 35. The general idea was that the last high was at 45, so if the pattern continued to develop, it should be moving towards 45 to continue the contraction. Options are not linear instruments, so it's hard to make conventional comparisons to a stock trade, but in terms of target price and stop loss, I use the possible values at expiry as a guideline. For example, in this case, that would imply a potential 5% gain versus a 1.75 loss, considering a stop loss at 33.25. The stop loss level was chosen because it was 5% below the put strike, in order to have some breathing room. So, if we look at the trade in simple terms, we will say it had a risk versus reward ratio of 2.85. Here we can see an extract of my actual blotter. Given the structure of the trade, I got paid 12 cents to enter the trade. If all the options expire worthless, I make a little money. I also wanted to show you some of the metrics I log for every options trade I make, like delta, implied volatility, IV rank, and IV percentile. It's good to have as much information as possible for analyzing trades later from different angles. As it often happens, the trade is not working as I expected right away. On December 1st, 2021, LVS gets really close to the stop loss. At this point, pretty much any minor move to the downside the next day will take me out of the trade. So, I decide to make an asymmetrical bet. The short call value has dropped by more than half, and given the lower delta it has now, it won't drop much more tomorrow if LVS actually hits the stop loss. On the other hand, if LVS holds and the stop loss is not triggered, this is the window where I can remove the ceiling of my call spread for a very good price. So, I decide to buy back the short call at 45. I'm not considering the valuations of the options at this moment, but just looking at the realized buys and sells, now the trade is costing me 88 cents. Although LVS gets close to the stop loss a few more times, it is never triggered. The trade just keeps going about for a month and a half. The price has been consolidating towards 40 rather than 45. Thankfully, I gave my trade enough time. The options expire in March, and I still have plenty of time before I have to consider a rollover or closing the trade altogether given the time factor. Also, since I'm long a call and short a put, the time decay doesn't really concern me. If the call loses value because of theta, so does the put. They are pretty much compensating each other in that regard. On January 14, 2022, LVS has a nice spike in price and volume. With a logic similar to the one I used for closing the short call, I decide to close my short put. Looking at the realized buys and sells, now I have paid 1.87 for being long the 40 put. That premium amount is really close to my original stop loss of 1.75, so the trade is self-contained now. No more need for stop loss. Now I'm just long a call and can patiently wait for LVS to move towards my target of 45, with controlled risk since there are only two scenarios at expiry. 1. LVS closes above 40, the call will have a positive intrinsic value equal to the difference between the spot and the strike. Or 2. LVS closes at or below 40, the call expires worthless and I lose the premium paid, 1.87. Finally, a few days later, on January 20, LVS reaches the 45 target. I'm really tempted to leave the position open as is or sell an out-of-the-money call to collect some premium and lock in a zero-cost trade. However, the market in general is deteriorating fast, so I decide to just close my position and take the profit of 4.19. If you found this information useful and interesting, please don't forget to like this video. If you haven't already, I invite you to subscribe to the channel and turn on notifications so you don't miss future videos. Remember that everything presented here is for educational purposes only. Thanks for your time.